What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 20th of 2019. Well, folks, I hope you are having a fantastic day wherever you are, and in today's update, I want to try to address the question of whether or not we have some warning signs flashing in equity markets of a potential correction or even the beginning steps to a global recession in equity markets. There's a lot of things that have gotten me interested over the last few years, but what's really gotten me interested over the last few days that I want to discuss today are talking about the short-term and long-term view of the S&P 500 as well as visiting the well-known volatility index, the VIX. So we've got a lot of things to discuss, but we're going to be talking about it right after our quick sponsor. And our sponsor for today's video is eToro. Now, for those of you who are hearing about them for the first time, eToro is a social trading platform that not only allows you to buy some of the top tier cryptocurrencies available on the market, but along with that, allows you to buy basketed portfolios that diversify your exposure to the crypto space, all from within the eToro platform. The really unique selling point, though, it comes in the fact that eToro is a social trading platform. So it not only allows you to showcase your portfolio, but you can also see the portfolios of others on the eToro platform real time. And for those of you who are in the United States, they've recently opened up to U.S. customers, so you can sign up today and register a free virtual trading account with up to $100,000 to test out your trading strategies. So for more information, definitely check out the link down below to get started today. Alrighty, everyone, so let's go ahead and dive right into the charts here. And before we turn on our drawings here and try to talk about the short-term, long-term view, as well as diving into the VIX, so the volatility index for the S&P 500, I want to go ahead and try to get some perspective here, right? So if we take a look here at the weekly, it's very clear we have been on the longest economic expansion in U.S. history. This has been a massive rally across the board without any severe real recession by any means. Now, I think we all understand that this expansion has been prolonged and propagated due to central bank mismanagement of pumping in mass amounts of cash, buying up toxic assets, as you probably know, quantitative easing, lowering interest rates to artificially low levels. In fact, in some countries across the world, negative interest rates. So you're being paid, in this case, to speculate and borrow. But there's all these things coming into play here, right? But I want to go ahead and talk a little bit more on a shorter time frame, because we can see here for the most part that equity markets really kept on a relatively steady trend. We had some declines, we had some corrections back in the past, but nothing was severe as the last 2 years of price action, where even though we are setting new highs, we have continued the expansion. At the same time, we've had some very scary positions for the not only the S&P 500, but if you take a look at the more volatile indexes that have been yielding in the market, like the NASDAQ, which has some of the big tech companies, these corrections are even more exacerbated. They're even larger. But if we take a look at the S&P 500, I remember back here in January of 2018, we cut down months worth of price action in a matter of a few trading days. And we still don't know exactly what had caused this at the time. I think it was just generally the kind of parabolic nature of price action. But we'd even talked about this correction back here in September of 2018, leading up to October where the correction really started. And this was due to the fact that I was learning a little bit about, at the time, something known as stock buyback blackout periods. It's basically where companies couldn't buy their own shares for a certain time window, and you had a growing number of companies that couldn't because of earnings releases, right? So when a company is releasing their earnings, there's a certain restriction on a certain date period where they cannot buy their own shares. And when a vast majority of S&P 500 companies, around 80%, couldn't buy back their own shares, this led to a lot of cash drying up on the buy side of equity markets. And we've talked about it. The only net inflower of capital since 2008 into equity markets have been non-financial corporations, and that is companies buying back their own stock, right? So again, this led towards a massive correction, a 20% correction in the S&P 500, and an even more severe correction in the NASDAQ and some of the smaller cap indexes. But again, as we talked about, the market finds a way to keep things up. They used $84 billion of fixed income investments rotating into equities at the lows down here. So a bunch of pension fund managers basically took money, again, a select few people took trillions of dollars in this case, were adjusting it around, and they put $84 billion of that wealth back into buying equities on the dip. And that, as well as a variety of other things, continued company stock buybacks, dividend increases, whatever it may be, kept stocks alive. It kept us on life support. And we have not been setting that much of a larger high each and every time we set new highs, right? For example, we set a high here, revisited back around this high, and then we set a new high here back at the major 3,000 mark for the S&P 500. So a lot of people would look at this as we start to see this increase in volatility. a risk and an uncertainty in the market. A lot of people will be curious, what can we tell from the chart here in the short term, long term, and the VIX? Well, let's go ahead and turn on some drawings here. Let's first start off by taking a look at the short-term window, right? So we've already been building a pretty major wedge here, a pretty prolonged one with rising lows and lowering highs here over the last few days. I'll even adjust my line here a tad bit just to line up better with the first high. But we can see here that we're setting lower highs, which is not a good sign for markets. And we can see that in the past and still break through it, right? But along with that, we're setting these higher lows. And it's coiling in price towards a very narrow range where it's going to have to make a decision to move upward or downward, right? A severe move of some sort in a very short window of time, anywhere between here and the beginning of 2020, right? So we see this coming into play here. We know that there has to be some kind of momentous move. The question is whether or not we can gain anything from the long-term view in the VIX or anything else outside of that to get a perspective as to whether or not it's going to move higher and set new highs, or begin to start correcting like we saw back in October of 2018 and really start possibly hinting towards a global recession. Right? Well, this has to do with inflows and outflows. And as we talked about, the thing that has been keeping up equity markets has really been the vast amount of cash that corporations have had on their balance sheet. And it's sad. I mean, what we're really seeing, and this is why, for example, as much as we've had a major tax cut in the United States, which helped prolong this rally from 2017 onward, we really haven't seen much of that money come into the economy. We've been having an issue where companies, because the shareholders of these companies that are on the board of directors that manage the balance sheet, have decided to repurchase stock as we've seen at the same time record insider selling, basically the selling of shares by people who own stock in the company and work at the company. So we've been seeing a record amount of them selling shares and using the company's cash on their balance sheet to pick up and buy those shares. And the issue is that this sets a limitation on shares in the market. It props up prices, and it's not money really invested in the underlying economy. But at least we understand this is what has kept up equities. So the question here is whether or not those inflows are going to increase. Well, let's go ahead and step in the long-term view, right? I'm going to go ahead here, remove some of these drawings, and really just kind of focus in on the key nature here, right? So we, for example, have recently hit the S&P 500, or the SPX, as it's otherwise known as, the S&P 500, at 3,000 points, right? This is an index that weighs the top 500 companies traded publicly in the United States, and it gives us a good weighted measure of where the market is going. When these indexes hit very big even levels, it is a time to notice. It's a time to reflect and think about whether or not at the current moment there's a favorable risk to reward. If there's enough inflows that are going to match or outpace the outflows in the market, people selling in mass quantities. And quite frankly, this is something that I've watched for a very, very long time. Even back here when we had the correction in 2015, I remember when I was talking to one of my friends, who's one of my foreign friends who used to trade U.S. markets. One thing that we always talked about was looking for these big even levels. And one that I thought of, if one day we were able to reach it, I had a hard time believing it, but they found a way to prolong the rally as long as they have. That 3,000 would be a very key even level because, as we tend to know, right, I think many of us know, that recessions usually end up in 50% corrections across the market. I even have it highlighted here on the chart. We had both a 50 and a 57% correction in the last two pullbacks in the S&P 500. And it's standard in most markets to have a 50% correction. Well, if we take a look at this long-term view, and we also take a look at the principle that I've talked about on the channel a lot, which is previous resistance becomes new support once it's surpassed, this would make perfect sense. That if there's not enough stock buybacks, and we've already talked about on the channel, there's been a dry up in the stock buybacks. Stock buybacks have been on a quarterly decline for the last 2 quarters. We're waiting for Q3 data to come out. So we've been seeing a sharp decline, the biggest decline we've seen in stock buybacks since 2008. And we're now seeing it at a time where a perfect 50% correction would line up at these levels downward to 1,500, right? So this is really the thing to think about here. Could this be the moment we finally start to see a recession, a correction of some sort? And honestly, I think it's not only plausible, but it would be extremely healthy. This is the perfect moment to do it, to have a 50% correction. And we're still resting on top of the highs of the crazy dot-com era back in the 2000s, as well as on top of the housing bubble and the valuations we had back in 2006 and 2007, right? And even if we don't pull back that far, it might be good to see a correction down here to 1800 or down here to 2100. Either way, it looks like, at least on the long-term view, this is the time period we can expect it. This is the time period where we're seeing a massive dry-up of capital in the financial system. As we talked about a few weeks ago, with the, actually I'd say it's been about a month now, with the Fed repo market, which is the repurchase agreement market, where banks are lending money overnight, we saw that the Fed had an emergency step in. We still don't know exactly who it is, what company was insolvent on cash in the short term, but the Fed stepped in a dramatic way by propping in cash into the banking sector. And this is supposed to be seen as short term, right? This is supposed to be seen as less than about 2 weeks of capital being provided. It shouldn't be anything further past that, right? It's not supposed to be quantitative easing where we bought assets from banks for a near decade to provide relief to the financial system. But in reality, we've not only seen a massive spike far beyond what the Fed was originally stating it was going to do, but we've now starting to see what was appearing to be a correction, a pullback, a step back into reality, and hopefully a strengthening financial system. It seems there are still issues in the financial system, in the plumbing of the financial system. There's not enough cash available to the current banks to meet the reserve ratios. We can see that we went from a near 165 billion back to 205 billion back on October 17th. So we just set new highs on the repo market stimulus that the Fed has provided, and it doesn't seem like it's getting any better, right? And again, as I mentioned, we're seeing this happen at a time where general equity markets are already drying up on cash at these levels because stock buybacks are decaying. Dividends are not increasing at the rate they previously were, so that's less incentive for shareholders to hold the stock, right? So when you keep these elements in mind, right, when you see a declining set of corporate earnings that have led to this decline in stock buybacks, when you're seeing insolvency in the financial system in the sense of the available cash on the books, the reserve ratios, which are a measurement of health, and a certain set of restrictions that the financial sector is obligated to hold in order to make sure we don't have recessions, well, those are some worrying signs, right? It's not me just trying to spread FUD or fear around markets in any regard. It's just taking in the reality of the case scenario. And the reason I say that is because markets are built off very simple principles, guys. It's inflows and outflows. And if the inflows stop growing at the rate they were previously, like they were at the bottom in the exit of the recession, and then also when we had the tax breaks, right? The cut in corporate tax, the cut in income tax brackets that have led to a lot of capital fleeing to equity markets. When that dries up, we need to plan accordingly, okay? Now, there's another thing I want to talk about, right? You've already seen, as I've talked about, the short-term view, we're expecting something to come soon. The long-term view looks like it could be very well setting up for a 50% correction over the next few years. But there's also something else that we want to take a look at. We're going to go ahead and take it back here to the daily. And we're going to take a look at the VIX, the CBOE Volatility S&P 500 Index. Now, we've been talking on my newsletter about how the VIX has been holding a higher level for well over, for 19 months now. It's been holding above the 10 point on the index. And we can see here that for the longest period of time, we can actually take it to the weekly here for a moment. We've seen how when we exit out of recessions, right, when we had the spike up here in the VIX, and the VIX increases when there is declines in markets because there's an increase in volatility. And it can increase on the upside as well when there's uncertainty in price. There's a lot of volatility or certain basically closes on the market at variable ranges in a short frame of time. But we tend to see that as we exit out of these corrective periods, right, we start to see markets go up and the VIX sets lower and lower levels. But when we start to set higher lows in the VIX, uncertainty is increasing and price is usually starting to decline. And that's exactly what we got here in 2007. Well, we had the same thing here over the last decade where the VIX has been lowering, but now we're not only setting a higher set of support for the VIX, which means more uncertainty in markets, but we're starting to increase those lows on the VIX. We've been doing that consistently 4 times in a row. And as we see this continue to go through, there's something that I'm concerned about. I see a squeeze happening in the VIX, and that's between the highs that we've been setting. So we've been setting lower highs on the VIX, meaning that the sell-offs we've been having are at smaller levels, to be fair. But we've also been setting higher lows here in the VIX, which means that markets are not returning to that kind of safe haven mentality that, you know, we're going to record highs, the market's going to keep climbing, everything is good and fine and dandy like it was over the last decade. And we're now narrowing into a very interesting wedge that, interestingly enough, is building up into the same range as we talked about on the S&P 500, right? This kind of wedge that we've been building here between the lowering highs and the higher lows, right? So they're both leading up here into January of 2020. And what I think you're going to see is if we break past this line here, if we have enough severe volatility coming in, or maybe if we set 1/5 higher level here on this curve or this curved or exponential line, then I think we're going to get to a point where we're finally entering into the cusp of the recession. We're going to finally start entering into a corrective period for markets. So I'm sorry if I rambled on a little bit, guys. These are kind of the major things I'm watching. Again, I look for these early warning signs. History has taught us this. And the thing is, the problem is most people don't look at the VIX and the S&P 500 in these ways. They look on very short time frames. They're trying to trade on very short movements. I'm a swing trader. I'm a macro trader. I trade the longer term moves that are much more predictable if we turn towards history. And again, whether it be the fundamental principles of capital inflows and outflows or taking a look at the charts here, I have to say it looks relatively grim. And this is why since 2018, I've stayed clear of equity markets. And I've done much better in crypto markets, even with the 80% correction that we've had, done much better in crypto markets. And also, if anything, I'm interested in commodity markets as well, from gold to silver, because this is where we start to see people looking for hedges, right? We've had a massive rally, 34% rally in gold this year. And also for silver as well, we've had a nice pickup as well, where we've seen lows as far as $13.92 all the way up to near $19.65 per ounce, right? So a lot of interesting moves. We have not seen this in a long time. We haven't seen this kind of breach on the resistance line for silver, right? It's a matter of really getting above the previous highs over here. I think that's going to be the telling sign we're in a silver bull market. For gold as well, looks like we're relatively on our pace here after this correction to test out to previous highs and move higher, going into new highs that we haven't seen before. Anyways, that's a little bit of an analysis, guys. I hope you all enjoyed this video. If you liked it, please drop a like on the video. Leave a comment down below on your thoughts, whether you agree or disagree. I'd love to hear down below and get a discussion going with you guys. But until the next video, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.